S&P and NASDAQ both trying for record closing highs yet again today. Investors bracing for tomorrow's critical jobs report and what it might mean for the fate of this rally. Joining us now, Ed Clissold. He is chief U.S. strategist at Ned Davis Research. Good to see you. You say it's still time to just be bullish, right? Stay bullish?
Yeah, there's not a whole lot of reasons to get off what has been so far a really good year. You know, the Q1 earnings season's wrapping up with over 80% of companies beating estimates. Looks like Q2 is going to have an acceleration in earnings growth. We're looking at economic slowdown, no immediate recession. The excessive optimism that we saw in March has been largely worked off. A little bit crept back into the market as we hit new highs again, but it's not as excessive as it was back in March. And the long-term technicals look positive. 2/3 of stocks are above their 200-day moving averages. Now, there's been some short-term technical damage. You want to keep an eye on that. But for the most part, it's a bull market until proven otherwise.
All right. So you say optimism is not as extreme as it was before. Some would chuckle at that, perhaps, and say, have you been watching NVIDIA lately?
Well, yeah, there certainly have been pockets, and I think that's probably symptomatic what you see in the technical side as well, that you've seen more people pile into fewer names. You know, the best rallies are the ones that are very broad, that have lots of stocks participating. So if you look at, say, when we made new highs in May in the popular averages, fewer stocks were above their 200-day moving averages, and they were in March. Now, it's still a high level, but you want to watch out that it doesn't become too narrow. These things usually unfold over several months, and you have a few cycles of new highs with worsening breadth. So we don't want to jump the gun here, but it's something we need to keep an eye on, particularly if you get sometimes you get these summer rallies that are a little listful with not a lot of volume that can lead to a bigger correction in the fall. So that's what's on our radar.
Does the move in some of these mega cap names make you at all nervous that it's too much, or does it embolden you to just be more bullish that this is where the leadership is, this is where the leadership's going to remain, so let's keep riding it?
Well, if you look at the earnings that a lot of these companies have produced, they've been fantastic. And what I really like about it is that they've refocused on shareholder capitalism. That is, you've seen a reemphasis on buybacks, increasing dividends, which we haven't seen as much in the last couple of years. So it's amazing these companies can, on the one hand, put billions into AI and other CapEx, and on the other hand, return so much to shareholders. So the fundamentals support that. So that in that regard, it's okay. Again, we just want to make sure they don't become the only game in town, in which case, then when they inevitably have a problem, there's nothing left for the market to stand on.
You know, when you listed some of the reasons why you're remaining bullish, one of the things I heard you say was, the economy is slowing, and that's a bullish signal, presumably because you think that rate cuts under almost any circumstance are good.
Well, yeah, thanks for asking me to clarify. It's predicated on a soft landing. A hard landing would certainly be a negative scenario. And in a soft landing, the Fed would cut rates slowly. That's what they did, say, in 1995, and the market did quite well. When the Fed cuts very quickly, that is 5 or more times in a year. That's what they started doing in 2019, 2001, 2007. Now, we're doing that because something's gone terribly wrong with the economy, and they're chasing their own tail. That's what we don't want to see. So a slowdown in economic activity that comes with a few rate cuts, that's a bullish scenario. The other scenario would be really problematic. That's when you get the really nasty bear markets around a recession.